Welcome back to Market Craft's Deep Dive. This is where we take those complex stacks of financial reports, internal memos, board notes, all that dense analysis.
Yeah, the stuff nobody really has time to wade through.
Exactly. And we boil it down fast to what you, the curious learner, really need to understand about the companies shaping our markets. Today, it's Urban Company Ltd.
A big one. Pretty much defining that hyperlocal home services space, not just in India, but across parts of Asia now, too.
Right. So our mission today is threefold, really. First, we need to get straight to the core drivers. How did this company, known for high growth but also burning cash, suddenly turn profitable? What actually changed?
That's the million-dollar question, isn't it? Or maybe the billion-dollar one.
Maybe. Second, we've got to look at their competitive advantage, their moat, as people love to say. Is it real? Is it durable? What actually is it?
And that's crucial because lots of platforms look similar on the surface.
And third, and this is maybe the most interesting bit looking forward, we need to understand the big strategic bets they're making, especially this shift towards selling their own hardware, becoming an integrated product and service company. What does that mean for their future?
Okay, so we've gone through a pretty significant pile of documents for this. We're looking mainly at their fiscal year 2025 results, which really do feel like a major inflection point.
FY25, ending March 2025.
Correct. And we've paired those financials with internal strategy memos, the ones outlining their sort of 5-year vision. It gives you a pretty holistic picture.
So it's not just number crunching.
No, not at all. It's about getting under the hood of their operational model. They call it the full stack approach. And you really need to grasp that to understand the unit economics and also the big risks they face, particularly on the regulatory side.
That phrase, full stack operator versus just being a marketplace, that seems key. It sounds like that's fundamental to why they might have a lasting edge.
It absolutely is.
Okay.
It's the core of their potential moat.
Okay, well, let's dive right in then. We have to start with the headline news, the thing that really made everyone sit up and take notice, right? The big one. That swing to profitability. Urban Company hit profit before tax PBT profitability in FY25. They reported 28.6 crore.
Which, compared to the year before.
Exactly. A massive turnaround from a pretty substantial loss, 93 crore in FY24. I mean, that's the kind of shift investors look for.
It's a huge operational achievement, definitely. But we do need to add a bit of crucial clarity here for you, the listener. You might have seen bigger profit numbers floating around.
You mean the profit after tax, the PAT figure?
Precisely. They reported a PT of 239.8 crore, which sounds, absolutely spectacular.
But there's a catch.
There is, a big one. That number includes a very large, non-cash, one-time accounting benefit. It's a deferred tax asset recognition, basically an accounting gain, worth about 211 crore.
Okay, so that's not cash profit from running the business day to day.
Not at all. It's an accounting adjustment based on past losses and future profit expectations. So if you strip that away.
Let's get back to that PBT number.
The 28.6 crore. Exactly. And that PBT figure is the real indicator of the underlying operational performance. It shows the core business, the actual buying and selling of services and products, is now generating a profit from its activities before taxes without any of these one-off tax items.
So the turnaround is real, operationally speaking, not just an accounting quirk.
Absolutely. It's driven by efficiency gains, not tax adjustments.
Okay, let's unpack this. How did they actually manage it? Because revenue growth was good, definitely strong, 38% year over year, hitting over our 144.5 crore in FY25.
Which is robust growth by any measure.
But the sources seem to suggest the real magic, the key to profitability, was operating leverage. Can you explain that?
Yeah, it basically means they managed to grow that revenue much faster than their costs grew. Their cost structure proved to be highly scalable.
Meaning they didn't have to spend proportionally more to earn more?
Exactly. Instead of costs rising 38% alongside revenue, key costs were kept much tighter. We see this really clearly if you look at some specific line items. Take employee benefit expenses. This is their corporate staff, engineers, trainers, not the service partners, but the actual company employees.
Right, the fixed overheads in a sense.
Sort of, yeah.
Yeah.
Semi-fixed, maybe. Anyway, despite revenue jumping 38%, these employee costs, they only grew by 1.5% year over year.
1.5%. That's basically flat. How is that even possible? Surely you need more people to manage 38% more business.
Well, this is where that tech-driven platform idea really shows its value. The documents suggest the investments they made years ago in their core technology,
Things like the scheduling algorithms, partner matching.
Exactly. Cloud infrastructure, internal AI tools for managing tasks, logistics, payments. All that back-end stuff is now handling vastly more volume without needing a proportional increase in human oversight.
So the software is scaling even if the headcount isn't nearly as much.
That's the essence of G&A leverage, general and administrative leverage. They built the engine, and now it can handle more horsepower without needing a bigger chassis, metaphorically speaking. They didn't need to hire armies of back-office staff.
Okay, that covers the internal costs, the G&A side. But what about acquiring customers? Sales and marketing, S&M. That's usually where platforms burn cash like crazy when they're growing fast.
And that's maybe even more revealing about the underlying strength of the business, particularly the demand side. Their total spend on advertising and promotion, it was held almost flat.
Flat. While revenue grew 38%.
Pretty much. It hovered somewhere between, I think, 173 crore and 207 crore over the last couple of years, so roughly the same ad budget delivered significantly more revenue.
The maths on that is pretty impressive. Your marketing efficiency just shot through the roof.
It's the clearest sign of operating leverage in action. We measure this by looking at S&M as a percentage of revenue. Ad spend used to be a massive chunk thing, 38.3% of operating revenue back in FY22.
Wow, over a third of revenue just on ads.
Yeah. But by FY25, that dropped dramatically. It's estimated down to around 15.1%.
15%, that's a huge improvement. What does that tell us?
It tells us the cost to acquire that revenue is falling off a cliff. Why? Because customers they brought onto the platform maybe 2-3 years ago are still ordering today. They're generating revenue repeatedly, but the company isn't spending much, if anything, to reacquire them.
So it's the loyalty kicking in?
Precisely. Those cost savings from reduced marketing per unit of revenue flow straight down to the bottom line, to the operating profit. That's what enabled this critical pivot to PBT profitability. Okay, so cost control and leverage got them to profit. What's fascinating here is looking at how they plan to keep growing and growing profitably. It's not just about cutting costs anymore.
Right. What's driving the top line now and going forward?
The analysis points to 3 main growth vectors. You've got volume, which is really about repeat usage and loyalty. Then there's a really critical mix shift happening toward their own products. And finally, there's still geographic expansion.
Let's start with volume and link it back to that S&M leverage we just talked about. That falling ad spend percentage is only possible because of customer loyalty, right?
Absolutely. That loyalty is the foundation. The numbers are pretty stark. They hit 6.8 million annual transacting users in FY25.
Which is a decent base.
It is. But the really sticky number, the one that underpins the model, is the repeat usage. In FY25, 82% of their net transaction value NTV, which is the total value of all services booked to the platform.
Okay, the gross value of everything sold.
Yeah, the GMV essentially for services, 82% of that came from repeat customers.
82%. And that's up from previous years.
It is. It was 77% just 2 years prior in FY23.
Going from 77% to 82% in 2 years. That's a significant tightening of the customer relationship. It creates a really predictable base of demand.
Hugely predictable. It fundamentally de-risks the model. They're far less reliant on expensive, often subsidized new customer acquisition campaigns. Once someone's on the platform and has a good experience, the data shows there's an 82% chance they'll be back. Their customer lifetime value, or LTV, gets healthy very quickly.
And if you have that loyal base, the next logical step is to sell them more things.
Exactly. Which brings us to maybe the most profound change in their business right now, and arguably the highest impact growth engine. That critical mix shift into their own native products.
This is where they're moving beyond just being a marketplace.
This is the strategic evolution. They're not just taking a 20% cut on someone else's service anymore. The native product line. This is their own branded direct-to-consumer hardware.
Things like the RO water purifiers, smart locks.
Yeah, water heaters too now, I believe.
Yeah.
That line is the primary driver of their current top-line acceleration. The growth there was, well, breathtaking. 303% year over year in FY25.
300% growth. Wow. And you mentioned this diversifies the revenue mix significantly.
It does. If you look at total product sales, that includes the D2C native stuff, plus sales of tools and supplies they make to their own service partners, it now accounts for 26.5% of their total operating revenue.
So over a quarter of their revenue is now from selling physical goods.
Right. And think about the margins. On a service, they get maybe a 22% commission or take rate. On their own DTC hardware, they capture potentially 100% of the gross margin.
Minus cost of goods sold, of course.
Of course, but the potential margin capture is much, much higher. It shifts the whole economic profile. They move up the value chain from just being a broker to being a retailer and a service provider integrated together.
The sources used a great example to illustrate this shift, the decision to launch their own RO water purifier brand. How did that come about?
It's a perfect case study in using platform data to spot an opportunity. They saw they were processing a huge number of repair requests for existing water purifiers, something like 45,000 to 50,000 every single month.
Okay, so they had unique insight into failure rates, customer pain points.
Exactly. They knew which models broke, what went wrong, and how frustrated customers were. They realized they had this massive captive audience already coming to them with a specific problem, looking for a reliable solution.
So instead of just sending a repair person, they thought, why don't we sell them a better purifier, one that we control?
Precisely. One perhaps designed for easier servicing, integrated with their own network. They turn a potentially annoying one-off repair job into a long-term relationship. The customer buys the device from Urban Company installs it, Urban Company services it, maybe handles filter replacements through a subscription.
It dramatically increases the lifetime value from that household.
Massively, to a much deeper, stickier relationship.
Okay, and the third growth vector was geographic scaling, still expanding beyond India.
Yes, the model seems to travel reasonably well. Their international operations, mainly UAE and Singapore, also grew strongly, up 64% year-over-year, reaching 147 crore in revenue in FY25.
So that's what, nearly 13% of the total top line now?
Just about. It's still smaller than the domestic business, obviously, but that 64% growth shows the core full-stack operational model isn't entirely dependent on unique Indian market conditions. It can be replicated, which is important for long-term growth potential.
Okay, so the numbers look good, profitability is there, the D2C product shift is aggressive and growing fast. But the big question remains, what stops someone else, maybe a big tech giant or well-funded startup, from just copying this? Where's the real moat?
And the answer, according to all the analysis we've seen, lies in that operational complexity. It's the full-stack model itself that creates the barrier.
So it's not just about having a slick app.
Not at all. Many early aggregators were just that lead gen platforms connecting customers to existing freelancers or small businesses. Urban Company realized early on, or pivoted to realize, that wasn't enough.
Because the underlying service quality was still chaotic and unreliable.
Exactly. The real job to be done for the customer wasn't just finding a plumber's phone number. It was eliminating the whole headache associated with the traditional unorganized market.
Which means getting rid of the uncertainty over arrival times, the haggling over price, the inconsistent quality of work, and frankly, the safety concerns of letting a stranger into your home.
Right. And delivering on that promise, reliability, standardization, safety, convenience, requires way more than just software. It requires deep operational control over the supply side.
Which means investing heavily in the service partners themselves.
Massively. This is the expensive, hard-to-scale part that actually builds the moat. The sources mention a cumulative investment money already spent of over 524 crore just on supply-side infrastructure.
₹500 million. What does that actually buy? Training centers.
Yes. That's a big part of it. They operate over 150 physical training centers. They have a dedicated team of over 200 full-time trainers. This isn't just an online course, it's hands-on skilling.
That sounds incredibly capital intensive, especially for a company focused on leverage. Doesn't that huge fixed cost base kind of contradict the operating leverage argument we were just making? Why not just outsource the vetting like competitors might?
That's a really sharp question, and the answer is kind of paradoxical. That high fixed cost is the moat. It's a deliberate, necessary investment that creates a huge barrier to entry for anyone wanting to replicate their quality standard.
So you spend the money up front to ensure quality.
You spend up front to tightly control quality, to standardize the service delivery, to enforce strict standard operating procedures or SOPs. They vet partners, do background checks, train them rigorously on both technical skills and soft skills.
And they provide standardized kits too, right? The branded tools and uniforms.
Exactly. All of that contributes to a consistent customer experience. And because they control the process, they can collect incredibly granular quality data, those customer ratings, which average a very high 4.81 out of 5.0.
That level of standardization and trust must have an impact on what they can charge.
Absolutely. It gives them pricing power because they offer something demonstrably better, more reliable, safer than the fragmented informal market, especially for complex or critical jobs. They can command a premium.
People are willing to pay more for certainty, especially when it comes to things like electrical work or messing with major appliances.
Precisely. That quality difference reduces demand elasticity. Once you've used the platform and had that reliable experience, you're much less likely to gamble on a cheaper, unknown provider next time, especially for non-discretionary services.
Okay, so the heavy upfront investment in training and infrastructure creates the quality, which builds trust, which allows premium pricing and drives repeat usage, which then enables the G&A and S&M leverage we talked about earlier. It all connects.
It's a virtuous cycle when it works.
Yes.
But you rightly identified the bottleneck earlier.
The supply side, finding and keeping enough good partners.
It remains the absolute core constraint. The entire system's growth is capped by their ability to successfully recruit, thoroughly train, and crucially, retain those 48,000 active service partners.
And training them isn't cheap. You mentioned that investment.
No. The sources estimate the upfront cost to acquire, vet, background check, train, and equip a new partner is significant, maybe somewhere in the 50,000 to 100,000 range per partner.
Wow. So you need that partner to stick around and complete a lot of jobs to recoup that investment.
Exactly. That capital investment only pays off if the partner has a reasonably long tenure on the platform. If partner churn, the rate at which partners leave spikes upwards, all that upfront training cost is just wasted. Service quality suffers because you have fewer experienced partners, wait times increase, and the whole value proposition starts to fray.
So partner satisfaction and retention isn't just a nice to have, it's existentially important for the model.
It's absolutely critical. Monitoring partner churn and earnings potential is probably as important as monitoring customer retention.
Let's dig a bit deeper into the money side then, the unit economics. How exactly do they make money? It sounds like it's more than just a simple commission now.
It is. It's a hybrid model with three main streams. The foundation is still the commission, or take rate, on the services booked through the platform. That averages around 22%. That's the main driver of gross margin on the pure service side.
Okay, the 22% cut. What else?
Then there's the upfront pricing model for most home services. They give you a fixed price before the job, based on standard scope. This removes the awkward negotiation part for the customer and provides transparency. It enhances the user experience significantly compared to the old way.
Right, no haggling with the electrician when they show up.
Exactly. And the third stream, which is increasingly important, is subscriptions. Their UC Plus membership program.
Ah, yes, the loyalty program. How significant is that?
It's become quite significant. It generated 98 crore in revenue in FY25. That's nearly 100 crore of recurring sticky revenue.
And what do members get for that?
Benefits like discounts on services, maybe priority booking, potentially some exclusive offers. It's designed to lock in their most frequent high-value customers and make the platform even stickier for them. It's high-margin revenue, too.
Okay, so commission, upfront pricing driving volume and satisfaction, and subscriptions for recurring revenue. Now this brings us to something that tripped me up a bit when looking at the numbers. The blended take rate calculation.
Oh, yes. That can be confusing.
Right. If the service commission is 22%, why does the overall calculation taking total operating revenue and dividing it by the net transaction value, NTV, come out much higher, closer to 35%, 1,144.5 CRO, 3,271 CR?
It's a good question, and the answer lies directly in that strategic shift towards selling their own products. Let's break it down.
Please do.
The NTV figure, that 3,271 crore, primarily reflects the total value of services booked on the platform. That's the base upon which the 22% service commission is calculated.
Okay, NTV is mostly services value.
Right. But the total operating revenue figure, the 1,144.5 crore in the numerator, includes more than just the service commission. Crucially, it includes 100% of the revenue from the sales of their own native hardware products.
Ah, I see. So the numerator includes all the purifier and smart lock sales revenue, but the denominator NTV mostly just reflects the value of the service jobs booked.
Exactly. So when you do that division, revenue NTV, the resulting percentage, 35%, is naturally higher than the pure service take rate. It's a blended rate that reflects the combined monetization from both service commissions and full product sales revenue.
So that 35% figure actually captures the increased monetization they get from integrating products into the model.
Precisely. It shows how selling hardware significantly boosts the overall revenue they extract per transaction or per customer interaction flowing through the platform.
Okay, that makes sense. Now, if we connect this to the bigger picture, you mentioned earlier how operational efficiency isn't just helping the profit and loss statement, but also the balance sheet through cash flow.
Yes, the cash cycle. This is a really powerful, often underappreciated advantage for platforms like this that handle the transaction flow.
How favorable is it?
Extremely. They operate with a negative cash conversion cycle. As of March 2025, it was reported at -94 days. Negative 94 days.
Minus 94 days? What does that mean in simple terms?
It means, on average, they collect cash from customers much earlier than they pay it out to their service partners. They hold on to the cash related to a transaction for roughly 94 days.
How does that work practically?
Well, think about it. You, the customer, often pay up front when you book the service, or maybe immediately after the job is done, usually via digital payment.
Right.
But Urban Company pays its service partners on a set schedule, maybe weekly, maybe bi-weekly. That lag between collecting the cash from you and paying the partner creates float.
Basically, they're using the cash generated by transactions as working capital before they have to pay it out.
Exactly. It's essentially interest-free financing generated internally by the business operations. This float helps fund their growth, reduces the need for external debt or equity financing for working capital needs.
And this shows up in their cash flow statement.
It does. They achieved positive cash flow from operations, CFO, in FY25, reporting 54.6 crore. This means the core business activities are actually generating the cash, not just accounting profit. That internal cash generation provides a lot of financial stability and flexibility.
Okay, so profitability is established, the unit economics look increasingly strong with the product mix, and they're generating cash. Let's look forward now. What's the big picture strategy, the 5-year plan mentioned in those memos?
The core theme seems to be a shift in focus. Less about just planting flags in new cities, the horizontal expansion, and more about going deeper vertically within the existing customer base.
Leveraging that 82% repeat rate you mentioned.
Exactly. If you have millions of customers already trusting you enough to come back 8 out of 10 times, the strategic imperative becomes, how do we increase our share of their household spending? How do we solve more of their home-related problems?
Which leads to this grand vision of becoming the operating system for the home.
That seems to be the aspirational goal. The idea is, if you trust Urban Company to fix your plumbing or AC today, why wouldn't you trust them to sell you the next AC? Install your smart home devices, manage warranties, schedule preventative maintenance, basically be the central hub for managing your home services and devices.
Okay, so pillar 1 of that strategy has to be doubling down on the native product ecosystem we talked about.
Absolutely. Even though we saw that division reported a loss in FY25 about 38.7 crore.
Which isn't insignificant.
No, but the strategic importance clearly outweighs that short-term P&L drag. That 303% growth shows they're getting traction, and the long-term bet here is transformative for the business model.
And the sources hinted at the next big move in this area, possibly air conditioners.
That's the specific high-leverage expansion rumored, launching their own native brand of ACs.
Why isn't AC specifically such a potential game changer compared to, say, a water purifier or a smart lock?
Scale and relationship depth. ACs are a much higher ticket purchase upfront than most other categories they're in. More importantly, they require professional installation, regular seasonal maintenance, and have a predictable repair cycle over their lifespan.
So if Urban Company sells you the AC unit itself,
They are perfectly positioned to capture the installation revenue, the high-margin biannual maintenance contracts, and any future repair work for the next 5-10 years. It turns a single product sale into a long-term, high-value, recurring service relationship.
it truly becomes a device-led recurring relationship, as the documents apparently put it.
Exactly. It dramatically increases the potential LTV they can capture from each household that buys into their ecosystem.
Okay, that's pillar 1, deeper product integration. What's pillar 2 for the future?
Pillar 2 seems focused on capturing the other end of the spectrum. High frequency, low ticket demand. The small, quick jobs. This is where their new InstaHelp service comes in.
Promising help in 15 minutes for small domestic tasks.
Something like that, yeah. It serves a couple of key strategic goals. First, it's a defensive move against newer, specialized instant service startups that might try to chip away at their customer base for quick fixes.
Creates a moat against that specific type of competitor.
Right. But second, and perhaps more important for their own operational efficiency, it's designed to improve partner utilization.
Keeping those 48,000 partners busy during potential downtime.
Precisely. Partners might have gaps between larger pre-scheduled appointments like an AC install or deep cleaning. InstaHelp aims to fill those gaps with quick, nearby tasks.
So it helps partners earn more money throughout the day, potentially increasing their loyalty and retention.
While also maximizing the return on that huge training investment the company made in them. Better utilization means better unit economics for the entire supply side of the platform.
Makes sense. Now, how does this vision translate into where they're actually planning to spend money, say, from an IPO or future funding? Capital allocation priorities.
The focus is clearly on deepening the moat and enabling this vertical integration. The documents mentioned, for example, earmarking around 190 crore, specifically for technology and cloud infrastructure.
And that's not just keeping the lights on, technologically speaking.
No, this seems to be for next-level capabilities. Things like enhancing the AI for even better partner matching, optimizing routes, predicting service needs, but also, critically, integrating the native product line deeper into the platform.
Like connecting a smart water purifier directly back to the app for diagnostics or filter alerts.
Exactly that kind of thing. Plus, ongoing investment in the physical side, more training centers, refining the curriculum, partner support systems. It's all about strengthening that full-stack control.
One last piece on strategy: disintermediation. The risk that a customer likes a partner, they exchange numbers, and next time they just transact offline to avoid the platform fee. How does this operating system vision help fight that?
It's arguably the most potent defense. You can't just rely on goodwill or contracts. You have to make the platform indispensable to both sides.
Provide value beyond just the initial matchmaking.
Right. If the platform becomes the single reliable place that holds the entire service history for your home, if it tracks the warranty for your native AC unit automatically, if it sends you smart reminders based on AI predicting when your RO filter needs changing.
Then bypassing the platform means losing all that added value, that history, that convenience.
Exactly. It becomes the central operating system managing the complexity of home maintenance. Why would you go offline and lose all that integrated benefit just to save a small percentage on one job? The goal is to make disintermediation illogical for both the customer and the partner, who also benefits from the scheduling tools, payment processing, and access to more jobs. #G sensitivities and the single point of regulatory failure. Okay, so the strategy is ambitious. The execution seems strong recently, but we have to talk about the risks, the sensitivities, and this really raises an important question. Despite all the operational improvements, what's the single biggest external threat that could derail this whole thing?
The documents were pretty unambiguous on this one, weren't they? Regulation, specifically around gig workers.
Absolutely. Regulatory change looms large. It's identified as the most significant external threat, the one thing that could potentially undermine the entire operating leverage model they've built.
There was talk of a kill shot scenario in the analysis. What does that refer to?
That refers to the potential legal reclassification of their service partners, the gig workers, as full-fledged employees under labor laws.
We know that would be bad, but can you walk through the financial impact? Why is it so devastating to the model?
Okay, think about how costs work now. Partner payouts are essentially treated as a variable cost of sale, offset by the commission or take rate they earn. The platform connects the supply and demand and takes a cut. If those 48,000 partners are suddenly deemed statutory employees, everything changes. Their payouts become a fixed operating expense. Salaries or minimum wage guarantees would likely apply. Plus, the company would be on the hook for payroll taxes, Social Security contributions, potential benefits, paid leave, all the costs associated with formal employment.
So that huge employee benefit expense line item we celebrated for being held flat.
It would explode upwards. It would completely destroy the G&A leverage they achieved. The fundamental economics of the business model would be broken, requiring a catastrophic overhaul or massive price increases.
Wow. Okay, so that's the kill shot. But even short of that extreme scenario, there are more immediate regulatory risks, right? Like that proposed code on Social Security in India.
Yes. That's a very real near-term risk factor highlighted. The Code on Social Security 2020, although not fully enacted or enforced yet in this specific aspect, contains provisions that could mandate platform aggregators contribute a percentage of their turnover, not profit, towards the Social Security fund for their gig workers.
A percentage of turnover. How much are we talking?
The proposals suggest anywhere from 1% to 2%. And crucially, it's often interpreted as potentially applying to the gross transaction value or net transaction value, not just the platform's revenue or commission.
Okay, let's put numbers on that. You said FY25 NTV was around 3,271 crore. What would a, say, 1.5% levy on that look like?
A 1.5% charge on 3,271 crore NTV would create a brand new mandatory expense of roughly 49 crore per year.
49 crore. Now, let's compare that to the profit number we started with, the PBT profit they just achieved.
Their reported PBT for FY25 was 28.6 crore.
So, a new Euro 49 core mandatory expense would wipe out their entire hard-won operating profit and plunge them back into a loss of over 20 core instantly.
Precisely. It highlights just how sensitive that recent profitability is to regulatory changes like this. It would force their hand they'd likely have to try and pass that cost on through higher prices to customers, which could hurt demand.
Or try to squeeze partner earnings further, which could massively increase churn.
Exactly. It's a very difficult position, a major risk they need to navigate carefully.
Okay, so regulation is the big external threat. What about internal operational risks? We keep coming back to the partners. Churn and satisfaction seem paramount.
They are. If partners aren't happy, if they're leaving in large numbers, the service quality degrades, wait times increase, customer satisfaction falls, and that virtuous cycle we discussed reverses very quickly. The moat erodes from the inside.
How does the company try to mitigate this beyond just paying them per job?
They use several tools. One key initiative mentioned is partner stock option plans, or PSOPs.
Giving stock options to gig workers, that seems unusual.
It is relatively novel, but strategically important. It aims to give partners a genuine equity stake, however small, in the platform's long-term success. It aligns incentives.
So it shifts the relationship slightly from purely transactional to having a shared interest in the company doing well.
That's the goal. It encourages loyalty, longer tenure, which helps recoup that training investment, and potentially reduces the incentive for partners to go offline or switch to a competitor. They also provide things like transparent earnings dashboards, access to loans or insurance partnerships, basically trying to enhance the overall value proposition for partners beyond just the per-job payout.
If you were tracking the health of the business over the next year or two, looking for early warning signs of trouble from either regulatory pressure or partner issues, what single metric would you watch most closely?
For me, the canary in the coal mine would still be that repeat customer rate. We celebrated it being at 82%. If that number starts to consistently tick down, say, below 80%, heading towards 75%,
What would that signal?
it would signal a deterioration in the core customer experience that could be due to longer wait times, lower service quality, often symptoms of rising partner churn or dissatisfaction. And if repeat rates fall, they're forced to spend more on marketing again to acquire new users, reversing those crucial operating leverage gains. It's a powerful leading indicator.
Okay. Lastly, on risks, we should touch on cyclicality. How exposed is the business to economic downturns?
The analysis suggests medium cyclicality. It's a mix. Some services are clearly discretionary things like beauty treatments, specialized cleaning, maybe home painting. Demand for those would likely soften if consumer spending tightens significantly.
People cut back on the nice-to-haves.
Exactly. But a large chunk of their business is in essential repairs, plumbing leaks, broken appliances, electrical faults. These are non-discretionary. If your AC breaks in peak summer or your geyser stops working, you need it fixed, regardless of the broader economy.
So that essential services base provides a buffer, some resilience during downturns.
Yes, it provides a relatively stable demand floor, making the overall business less vulnerable than one focused purely on discretionary spending.
All right, this has been a fascinating deep dive into Urban Company. It really feels like a company standing at a crossroads, but one where they've successfully navigated a major turn.
Definitely. The two big themes that really stand out from the analysis are, first, that achievement of profitability, and crucially, how they did it through disciplined cost control and unlocking that powerful operating leverage.
Holding those key costs like corporate staff and marketing almost flat while revenues surged 38%, that's textbook leverage in action.
It really is. And the second major theme is that clear, aggressive, strategic pivot they're making, moving beyond just being a service marketplace.
Towards becoming this integrated product and service ecosystem.
Exactly. That charge into native hardware with that 303% growth shows real intent. They're actively using the trust and data from their service business to build a potentially much larger, higher margin product business alongside it. They're not standing still.
And looking ahead, say over the next 5 years, if you had to pick the single most leveraged strategic move, the one thing that could really transform the company's valuation if they get it right, what would it be?
For me, it has to be the successful scaling of that native hardware ecosystem, particularly into those high-ticket, high-maintenance categories like air conditioners we discussed.
Because that locks in the long-term service relationship.
Precisely.
Yeah.
It shifts the model fundamentally towards higher margins from product sales and secures a sticky, recurring service revenue stream tied to that device. Pulling off that level of vertical integration successfully, That has the potential to dramatically increase LTV and reshape how the market values the entire company. But, and it's a big but, it requires sustained, near-flawless operational execution.
Which brings us neatly to our final provocative thought for you, the listener, to consider. We've seen that Urban Company's current profitability is really anchored on customer loyalty, that high 82% rebate rate enabling cost control. That's the demand side strength.
But we also saw that their ability to scale, their ability to maintain quality, and ultimately their durability is fundamentally constrained by the supply side, managing those 48,000 partners, their training, their utilization, their retention.
So here's the question to mull over. Given the significant regulatory risks hanging over the gig economy model and the sheer operational complexity of running this full-stack business, which metric do you think will ultimately be the more reliable predictor of Urban Company's long-term success over the next 5 years? Is it customer retention, reflecting the health of demand and LTV?
Or is it partner utilization and satisfaction, reflecting the health, capacity, and efficiency of the supply side that actually delivers the service? It's that constant tension between managing demand and executing supply flawlessly. Where should you focus your attention?
Something to think about as you watch their progress. That's all we have time for on this MarketCraft Deep Dive. Thanks for joining us.
Thanks, everyone.
We'll see you next time.